Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and of course one of the founding partners here in the Dividend Kings. Every Wednesday we have a Dividend Kings meeting where we discuss our service and how we can make it better for our subscribers, and when we strategize what we're going to write about and talk about and those kind of things. And a question came up in this week's meeting on Walt Disney. And one of our associates has a brother that owns apparently quite a bit. And so he put it out to the group, what do y'all think about Disney? And there were some of us that said, Disney's a great company, which I agree with, and it's a long-term hold. That they argued that earnings are expected to grow by 189% next year into 2020, which is fiscal year ends in September. And I agreed with that. That's the consensus estimate that we get from FactSet, which is the data provider for FastGraphs. But the point is, I wanted to look at that from a practical point of view and kind of discuss Disney. So I've got a valuation line here of a fair value PE of 15, which I believe Disney is worth, with a 10% growth rate. Now, to be fair, I can take this back to prior to COVID, because obviously this big drop in earnings here was a result of COVID, and Disney is a 14% grower, 13.81% growth. From the beginning of 2001 through 2017. And then, of course, as COVID hit, we had this huge collapse in earnings. But if I go back to 2006, prior to the Great Recession, Disney's earnings growth is at about 9%. These numbers are going to become a little more important. But here's what I want you to see. I've got a graph here that's really a 15-year historical graph. And the normal price earnings ratio for Disney is 17.81, which is higher than the 15. Okay, I want to make that clear. And keep in mind, we have an 88.63 blended PE ratio right now on Disney. In other words, the market's valuing it as that high value, but that's based on these distortedly low earnings because of COVID. Okay, so you need to take that into consideration. But let's just look at the PE ratios of Disney. I'm actually going to expand this all the way out as far as I can. And we can go back as far as 2001 or actually the end of, my first data on this graph will be November of 2000. And Disney had a PE of 51. Now, I want you to notice that led to almost a decade of a negative rate of return. That's a PE of 51 on Disney. If I look at the normal PEs, there was a time coming out of that recession where it traded at 25 and 30 times earnings temporarily, but really went nowhere. Most of the time it trades below this blue line, which is a PE of 21.53. If I shorten this time frame and get a more realistic PE, it's 17.61. And as you can see, every time Disney got above that, the price fell and it came down. But these are normal valuations for a company like Disney, a great company. 315 billion market cap, we'll call it. 373 billion enterprise value, which includes debt, moderate debt at 38%. And what's happened is Disney now has gotten momentum because, they were shut down during COVID. They couldn't make any money in the movies. Certainly their theme parks were completely shut down. And analysts now are expecting pretty good growth for Disney. But this 180%, 89% growth takes earnings to $5.04. So let's go to the forecasting calculator here and let's look at the normal multiple, and I'm using a normal multiple of 17.81. That's the 15-year normal multiple. And Disney earns $5.04. Then if it traded at that normal 18 multiple, which I think is extremely likely, you would only lose 48% of your money, or I'm going to call it for round numbers, a 30% annualized loss between now and the end of 2022. If I carry that out a little further, because earnings are expected to grow 189% this year to $5.04, and then another 23% to $6.18. And again, I apply that 19 PE, and I have a 37% total loss, or a 14% negative 14% annualized rate of return over the next 3 years. In other words, I see Disney as being dead money for those next 3 years. If I look at this from a longer-term growth perspective, there are analysts who do expect Disney to grow at double-digit rates, higher than they've ever grown before. Not sure of the logic behind that, but this is my most optimistic case. I still go out here to 2024, all the way out to 2024, where earnings would be expected to go to $7.67, and I'm only making 2.43% per year, and that includes dividends. So, I don't really see anything that tells me that Disney is anything but being significantly overvalued at this juncture. The stock has momentum, and this momentum is because people are looking for the company, as we've seen with the market, to basically recover. And so people start buying into the stock. But in my opinion, they've now bid this stock up to a price that's not only unsustainable, it's unrealistic based on any prudent, rational forecast for earnings. So I want to be clear, I like Disney a lot. This is an abnormal, once in a 100-year event. If I look at the company even through other recessions, it's not a recession-proof company. That's another thing I think investors should be aware of. It had a negative earnings growth of 24% coming out of the 2001 recession. During the Great Recession, it dropped earnings again another 20%. Of course, COVID gave a minus 19%, and then a forecast for a minus 65% for fiscal year. Remember, the fiscal year ends in September, followed by another 14% negative growth for fiscal year 2021. But then there's that 189% growth, taking it to $5 a share. But what would have to happen if you take $174, which is roughly what Disney's trading at now, and divide it by the $5.04, then that simply means that Disney would have to trade at a PE ratio of approximately 35 out to that year for it to be just breaking even. Now let me illustrate that for you. So here I've used a custom setting for fast graphs, and I've put a 35 PE on the graph for you. Now what I want you to first notice is, other than this one time back here and a little bit during, 02, 03, did Disney ever trade at a PE even close to that? So if I go out to the forecasting graph and go out to this $5.04, that would take Disney to 100. That would just, basically be a break even. I missed the, I used round numbers math there, but you get the point. In other words, Disney would have to trade at 35 times $5.04 2 years out just to maintain its current valuation, its current price, not make money. Even if it went to an optimistic 20 PE, 19.5 PE, you would still lose over 35% of your money. The point is, Disney is the greater fool stock, in my opinion. The greater fool theory says you foolishly pay more for a stock than it's worth solely on the basis that a fool greater than you would come along and pay you more. I love Disney. I'd love to own Disney again at somewhere between 15 and 18 times expected earnings, not distorted COVID earnings, but we're far piece away from that. So any of you that own Disney, my advice would be start taking some profit. At least take your money out. The stock does have momentum. You might want to watch it carefully and let it ride that momentum. But I would have it on a sell watch list, and I'd be prepared to protect these false profits. I call these false profits. When the stock is dramatically ahead of what earnings justify, those are profits you're really not entitled to as an investor, in my opinion, because the company hasn't generated them for you. Anyway, that's my take on Disney. I'm always talking about undervalued stocks. I wanted to, as Mr. Valuation, kind of talk here a little bit about a lesson in overvaluation and how dangerous it can really be if you just run some simple, prudent, and rational mathematics. Thanks for watching, everybody.